Hello, this is Dr. Karen Nunez. Welcome to ACC 350, the Chapter 1 lecture, Managerial Accounting and Cost Concepts, Chapter 1. So we are starting out by focusing on purposes of cost classification. So we need to classify costs because we have to assign them to the cost objects. What's a cost object? A cost object is anything that we require a separate measurement of costs for. We also need to be able to account for these costs in manufacturing companies. They produce product, and the costs have to be assigned to the product that they produce so that they can prepare their financial statements and report on their profitability or lack thereof. We also need to be able to predict cost behavior. So we have to plan, we have to forecast, and we need to be able to make decisions. That's why we need to be able to classify our costs. From a big picture perspective, when we begin this discussion of cost classification, there are two basic categories that we have. We have direct costs and we have indirect costs. Direct costs are costs that we can easily and conveniently trace to the cost object. For examples, for example, we have direct materials and direct labor. Indirect costs, on the other hand, are costs that we can't easily and conveniently trace to the cost object. A good example there would be manufacturing overhead. So the difference between the direct costs and indirect costs, direct costs are traceable, indirect costs are not traceable. And common costs are almost always going to fall in the category of indirect costs, those costs that support any number of cost objects or activities. They're typically not traceable. We can't trace them or we choose not to trace them. So they are indirect in nature. From a manufacturing standpoint, these costs that are direct costs and indirect costs. Again, good examples of the direct costs are what we're going to refer to as direct materials and direct labor. And then manufacturing overhead will be everything else in that manufacturing environment that is related to manufacturing. So in general, all of our product costs are classified into these three categories: direct materials, direct labor, and manufacturing overhead. And the first two, direct materials and direct labor, are traceable to the product or the cost object. The manufacturing overhead is not traceable to the product, or we choose not to trace it. What are the direct materials? Direct materials are those raw materials that are an integral part of the product, and they can be conveniently traced directly to the product or to the cost object. For example, if the product or the cost object is an automobile, the radio that you install in that automobile is traceable. It's a direct material cost. Now, there probably are some indirect materials, some materials that you use in your production of the automobile, for example, that you can't trace or you choose not to trace. So maybe there are some screws or nails or glue or other miscellaneous materials that you use in manufacturing an automobile. But certainly you wouldn't want to waste time and effort and resources to trace the amount of glue or the number of nails or screws that you use. Those are not integral to the product. They're not key, and it wouldn't be convenient to trace them. So those would be indirect materials or manufacturing overhead. And then there's direct labor. Direct labor are those labor costs that can be easily traced to individual units of product. And we typically think of direct labor as being the touch labor. That's the labor that is involved in physically touching the product during the manufacturing process. So an example would be the wages paid to the assembly workers. So again, direct labor is key. It's integral and it's traceable to that cost object. And it's that touch labor. Now, there's other labor that we incur in manufacturing a product, but it's not traceable. It's not touch labor. For example, the supervisor. So you have supervision in your manufacturing process, say the plant supervisor, for example. The plant supervisor is there to supervise the operation, not directly engaged in assembling the product. It's not touch labor. So that cost for the supervisor, that's a labor cost, but it's an indirect labor cost, or it would be overhead. So, in a manufacturing operation, the direct costs include the direct materials and the direct labor. Everything else, all other manufacturing costs would be classified as manufacturing overhead. So, in a manufacturing environment, we only have three kinds of costs related to manufacturing. Direct material, it's traceable to the product. Direct labor, it's traceable to the product or the cost object. And then everything else would be manufacturing overhead. And it's not traceable. Those indirect materials, they're not traceable, not easily or conveniently. And so we choose not to. The indirect labor, like the supervisor example I gave you, that's not traceable. It's not easily or conveniently traced to the cost object or to the product. So we only have three categories of manufacturing costs. Two of them are direct, the direct materials and the direct labor. They are traceable to the cost object, to the product. Manufacturing overhead is related to manufacturing, but it is not traceable to the cost object. Now, some more examples of manufacturing overhead. Depreciation on the equipment, the utility costs, the property taxes, the insurance premiums on the manufacturing facility. All of those are costs that are related to manufacturing, but they are not direct materials. They are not direct labor. They are not traceable. We classify them as manufacturing overhead. So only those costs that are associated with the manufacturing operation, right? That are not direct, the materials, the labor, if they're not direct materials, if they're not direct labor, but they're related to manufacturing, then they are indirect by nature and they are classified in manufacturing overhead. And we also, additionally, we refer to some of these direct costs, the direct material and the direct labor, we refer to them as prime costs. Those prime costs, again, are key, they're integral. And then we have the conversion costs, the cost to convert those direct materials. The direct labor and the manufacturing overhead are the conversion costs, the cost to convert the direct materials into finished product. Now, what about all of the other costs that are incurred? All of the non-manufacturing costs. Well, those costs are not at all related to manufacturing. If you have costs that are not incurred during the manufacturing process, then they are not manufacturing costs, like the selling costs and the administrative costs. They are not incurred during manufacturing. So that would also include things like distribution costs, the cost to distribute the product that you've sold to your customers. Those are selling costs. They're not manufacturing costs, right? All costs that are necessary to order and deliver the product. Those are indirect costs. Those are costs that are typically classified as non-manufacturing costs. Now, we can also take some of these selling costs and say that, they are traceable and they're not traceable, but they're never manufacturing costs, right? They could be direct non-manufacturing costs. They could be indirect non-manufacturing costs, but they're never ever going to be manufacturing costs because they're not related to manufacturing. They're related to selling the product, to ordering and delivering the product. They could be direct, they could be indirect, but they will never, ever, ever be manufacturing costs because they're not incurred during manufacturing. They are incurred outside of that manufacturing process. And then we also have administrative costs, executive, organizational, clerical costs. Those costs also could be direct or indirect, but they're never, ever, ever manufacturing costs. They're always non-manufacturing costs. So product costs only include costs that are involved in acquiring or making the product, direct materials, direct labor, and manufacturing overhead. And we say that those product costs are attached. They attach to every unit that we produce. And they stay with those units as long as they are in inventory until those units are sold. So in a manufacturing environment, we maintain inventory accounts and all of our product costs, all the materials, all the labor, all the overhead, all of those costs get attached to our product. So the materials, those direct materials costs, initially they go in the raw materials account. And then once we start production, the materials, the direct labor, and the manufacturing overhead, those costs are going to flow into the work in process account. And then when the goods are finished, when we complete production, all the costs leave work in process and they go to finished goods. So again, what we're saying is the raw materials along with the labor and the overhead are going to go into work in process. That work in process inventory account kind of mirrors the manufacturing operation where you add in the materials, you add in the labor, you add in the overhead. Everything goes into work in process. And then when you're done with production, the cost of those finished goods goes to what? The finished goods account. That's the cost of all goods that have been completed and are available for sale. And this is kind of a minor picture of it. So you can see inventory. And typically, in a manufacturing environment, the work in process account is where all of those manufacturing costs are, all the materials, all the labor, all the overhead. When those goods are completed, they're going to go to a finished goods account, right? So we have the cost of production going to a finished goods account. And when the goods are sold, well, that's where they go. They go to this cost of goods sold account. So the cost of all those goods is flowing through work in process to finished goods. Those are both inventory accounts. And when the goods are sold, they go to the cost of goods sold account. This is in effect an expense account that gets reported on the income statement. So we have the cost of goods sold, that expense that relates to those goods. It's all product costs, it's all materials, labor, and overhead, right? Those costs, when the goods are sold, are going to go to the income statement so that those costs can be matched with the revenue, matching principle in accounting. All of those non-manufacturing costs, we call those period costs. So product costs are the materials, the labor, the overhead, those three costs that we talked about earlier. The non-manufacturing costs are the period costs. They get expensed in the period under review. That's why they're called period costs. The selling costs, the administrative costs, all those costs that are not related to materials, labor, and overhead, all of those costs go to the income statement and they get expensed in the period under review. And now, once we have determined all of the costs have been accumulated and assigned to either materials, labor, or overhead, or as period costs, then we have to start moving beyond this cost accumulation and cost assignment and start thinking about classifying costs for prediction purposes, for predicting, forecasting, planning, budgeting, and ultimately decision making too. So when we focus on predicting cost behavior, there are three basic behavioral patterns that we use at this level: variable costs, fixed costs, and mixed costs. Variable costs, fixed costs, and mixed costs. Let's start with the variable costs. A variable cost is a cost that in total, in direct proportion, it varies in total and in direct proportion to changes in the level of activity. So graphically, a variable cost kind of looks like this. It extends out of the origin in a direct and upward fashion. This is the total cost on the y-axis, and this is the measure of activity, the volume, for example, on the x-axis. So as the volume increases, the total cost, the total variable cost increases. That's what this says, right? It's a cost that varies in total. Well, that's what it is, right? As the activity increases, the total increases in direct proportion. What does that mean? That means that they're moving at the same direction. So if you have, for example, a 10% increase in the activity, then what you would also see would be a 10% increase in the total cost. That's what direct proportion means. It means that the total cost moves in direct proportion to changes in the activity. But a variable cost per unit is constant. So a good example of that would be a variable cost for, say, direct materials, and say that variable cost is $1 per unit, right? So again, the variable cost is constant on a per unit basis. It's $1 per unit, right? Every time you sell another unit, you got materials cost of $1. So you sell one unit, the total cost is $1. You sell two units, the total cost is $2, right? So one unit, right? One times one unit would give you a total cost of $1. You sell two units, it's still $1, but now it's times two units, and that would give you $2. If you sell three units, then it would be one times three units or $3. That's what a variable cost is. The total varies directly and proportionally with the activity, right? So the total is varying directly and proportionally with the activity. But the per unit, well, the per unit is constant. It's $1 per unit. Every time you sell another unit, you've got variable costs that are only $1 per unit. But the total is going to vary directly and proportionally with the activity. That's a variable cost. And a fixed cost, well, a fixed cost is a little bit different. A fixed cost, well, graphically, it kind of looks like this, right? Same kind of graph. You have the measure of activity or the volume on the x-axis, and you have the total cost on this y-axis. It doesn't matter what the activity is, right? The cost stays the same. It's as you can see, constant. So, for example, if you have, say you have rent that is $1,000 a month. Well, it doesn't matter how many units you sell. The rent's $1,000 a month, right? Whether you're down here or here or here or here. That fixed cost is $1,000 per month. Is constant. So a fixed cost is a cost that remains constant in total, regardless of changes in the level of activity. But fixed cost on a per unit basis, well, that average fixed cost is going to vary inversely with changes in the activity. So imagine that this is 100 units and then next you have 200 units, right? And then imagine that next you have 300 units, right? Every time the activity changes, that fixed cost on average or on a per unit basis is going to change, right? So if you had 1,000, right? So an average cost on average, right? If you want to express a cost on average, then you're just dividing by the volume, right? So if you have, 100 units, then that would mean that that fixed cost on average is $10 a unit. But on the other hand, if your volume is ratcheted up and say you go from, 1 month making 100 units to the next month you make 200 units, well, then what happens is that per unit cost or that average cost is going to change to $5 a unit, right? So your activity is increasing. You see, you're going from 100 units to 200 units. Your activity is going up and your per unit cost on average is going down. And same thing if we continue in that fashion, right? If we continue to ratchet up that volume, right? So we go from 100 units to 200 units to 300 units. Well, the pattern's going to be the same, right? Every time you change your volume, your average fixed cost is going to change. So the fixed cost would go to $3.33 a unit, and that's kind of a repeating decimal there, but you get the idea. So we have here a cost that in total is constant. It's $1,000. It doesn't matter whether you go from 100 to 200 to 300 to 400 to 500. As long as you're within the relevant range of activity, the cost is $1,000 in total. But when you express it on a per unit basis, well, then it's going to vary inversely with changes in the activity, right? As the activity goes up, the cost per unit goes down. And the reverse is true. If the activity goes down, the cost per unit is going to go up. That's how a fixed cost behaves. Now, a fixed cost, as long as you're within the relevant range, you're going to have some cost that's constant. But if you go outside of that relevant range, then that fixed cost could actually start to change. Then it becomes more of a step function cost. And you could see various step levels of costs. You could have one cost level here at this activity, one cost level here, one cost level here. But as long as you remain within some relevant range, the cost is constant at that level of activity. That's what's true of a fixed cost in total. It's constant. So it helps in many cases to commit this to memory, right? As you try to understand and predict these cost behavior patterns, you need to know this, right? You need to know that a variable cost in total, it's going to vary in direct proportion to changes in the level of activity. It increases and decreases in proportion to the changes in the activity, but the per unit is constant. And a fixed cost, well, in fixed cost in total is not affected by changes because it's constant. But the per unit is going to decrease inversely or increase inversely with changes in the level of activity. And if you start to put some of these things together, right? So I showed you a graph for variable costs and a graph for fixed costs. This is a graph where they've put everything together. So again, this is X, our measure of activity, and this is Y, our total cost. And this is utility. It's a utility cost, which typically is what we call a mixed cost. So it's got a fixed component, right? That's what this is. This is the fixed cost here, right? It's constant. So there's some level of cost within this utility cost that is fixed. But then there's a variable component too. And when you take the fixed piece and you add the variable piece together, you get what is called a mixed cost. And a mixed cost kind of intersects that y-axis right here, right? It has some fixed component. That's what that is, right? But then it's got a variable piece that when you add it to the fixed piece, you get what is called a mixed cost. That's what a mixed cost is. It has both components. And a mixed cost algebraically looks like this. Y, the total cost is equal to A, which is the fixed cost, plus B, which is the variable cost, times the level of activity, right? So we have a utility cost that has a fixed component A, and it has a variable component B. And given the level of activity, we can determine what Y is, that total cost. And this is just an example of this mixed cost, this utility cost. The utility cost has a fixed monthly charge of $40. But as you continue to use kilowatts, then you incur a variable cost of 3 cents per kilowatt. So if you think your monthly level of activity is going to be 2,000 kilowatts, then your total cost is your fixed cost plus a 40 plus your variable cost of 3 cents per kilowatt times 2,000 kilowatts, or $100 for the month. So this is a month when you expect 2,000 kilowatts. The fixed component is constant in total, but the variable component, well, it's going to change, right? The variable cost is going to change based on the number of kilowatts you use, but the variable cost on a per unit basis, it's constant. And we ultimately need to be able to prepare financial statements. There are two formats that we look at in this chapter. The traditional format, which is what you should remember from financial accounting. The traditional format is your sales dollars minus the cost of goods sold, gives you your gross margin. And then subtract those period costs, the selling and admin costs, and you end up with the net operating income. That's used primarily for external reports. For our purposes, we need to be able to understand the traditional format, but also use the contribution format mostly, which is based on cost behavior. So we have our sales revenue dollars here minus all the variable expenses, all variable expenses. It gives us what we refer to as contribution margin. It's the contribution to those fixed expenses minus all the fixed expenses, and gives us our net operating income. So the traditional format based on what we use for external reporting, and the contribution format, which is used primarily internally. And that's it for chapter 1. I'll see you in the problem solving session for chapter 1. Take care. Bye.